So AI training costs are dropping 70% per year. AI inference costs are dropping 85% plus per year. So we're following that cost curve and we're saying, okay, as costs fall, unit growth is going to kick in.
So many of our compatriots, other strategists, economists, love to make the big market call.
Cathie Wood highlights the extreme market concentration, predicting a broadening as interest rates drop, creating significant opportunities. She emphasizes the transformative power of innovation, particularly in AI, where plummeting costs will drive rapid adoption and growth, aligning with ARK Invest's focus on disruptive technologies. She critiques traditional market timing, advocating for a stock-specific approach and maintaining her bullish stance on U.S. equities due to consistent growth and opportunities in small and mid-cap stock. Wood believes innovation and favorable U.S. financial policies will sustain the secular bull market despite skepticism. Drawing parallels to the Reagan era, Wood suggests that tax cuts and strategic tariffs under Trump could drive growth and strengthen the U.S. economy. She anticipates increased investment, a stronger dollar, and accelerated innovation, positioning the U.S. as a global leader in transformative growth.
The market has become so concentrated into so few stocks that we're going to see a broadening out of the market as interest rates come down. Now, 10 years ago, I would have said the same thing. We saw concentration, but in the last 6 months, it has reached an extreme that we have never seen before. So we think the opportunities are immense, and we want to provide a differentiated exposure to innovation. The cumulative doubling is taking place in less than a year's time, which is shocking. This has never happened before. Greetings, everyone. Well, we have more clarity now in terms of the investment landscape after the election. And I wanted to talk a little bit about deja vu for me. I started my career really in the early 80s. And at the time, we had the Reagan administration and a lot of controversy about everything, much of which we're hearing today, the same kinds of controversy. So I wanted to take you a little bit through the macros, what the Trump administration says it wants versus what might likely happen given that backdrop, as well as how this clarity is going to impact the world of innovation, the world of transformative innovation. And we believe the world is transforming and in miraculous ways. So we want to take you through some of that and how this administration, its policies are probably going to accelerate these changes. So let's talk about macros first. In the early days of the Reagan administration, there were back-to-back recessions and interest rates hit 15%. And that was a very difficult environment for investing. Well, President Trump is coming into office when that part of the equivalent in the Reagan administration has been done. And I remember after that, the 80s and 90s were the golden age of active equity investing. And I think we're going back there. First of all, in terms of the controversy, a deficit back then, after back-to-back recessions, 5.5%. The bond market was apoplectic about that. Investors were as well. And what they didn't understand is that the Reagan policies of tax cuts, along with lower interest rates, caused by Volcker, moving from double-digit interest rates to something much lower, that those were going to be very positive for economic growth, and that we were going to grow our way out of the deficit. That growth out of the deficit started in the 80s with the Reagan administration and finished in the 90s with the Clinton administration, taking us into a surplus. We think we're going to experience somewhat of the same thing this time around. The tax cuts, we believe, are critically important, especially if Trump makes good on his tariff promise. Now, I'm not a big fan of tariffs myself, but if we're going to pair tariffs not on our free trade partners, but on those countries that really are not giving American goods and services a level playing field, but we counter them at home with lower tax rates for consumers and businesses, that's a trade-off. That's a good trade-off. And so I don't think the criticism about tariffs is going to play out in terms of 100% across the board. That's not what we're talking about here. I think President Trump is very pro-growth, and he's not going to do anything to impede growth in that way. He wants the dollar down. He thinks that will make us more competitive. What I think will happen is the returns on invested capital in the United States relative to those elsewhere in the world, they're going to increase, and that is going to attract more capital, which will actually boost the dollar. Now, in terms of interest rates, the dollar going up is anti-inflationary, as is the productivity growth associated with a burst in activity caused by lower tax rates and other incentives for investing.
And they've been wrong just trying to call the market, and I think that they've really missed that the stock market is a market of stocks, and that's what's maintained our bullish stance, quite frankly, and consistently, and some people have called us stubborn, since 2009 when we came out with this call that U.S. stocks have entered a 25-year secular bull market. Now, it's tough to be bullish that long, especially given all the negativity and all the doubts. And in your first hour today, you had Mr. Cramer talking about sentiment being still negative, and it's true. And even the great Tom Lee earlier this hour was talking about all the cash on the sidelines and investors really doubting this, Carl. And it continues. It just baffles me. But for our sense is this, is that the U.S. market, in terms of an equity asset, remains the best asset in the world, number one. Number two, you get what you pay for. Too many people are focused on valuation. Valuation is the world's worst metric in terms of forward performance. Number three, in terms of what we're going to be seeing over the next 3 to 5 years with respect to U.S. growth, it is going to be consistent. We may have other areas of the world that are seeing quote-unquote snapback growth, but in terms of earnings growth consistency, we continue to believe it's going to be the United States.
So that leads you to what, your $275 number on EPS?
It does. And our base case is $275, Carl. But we think that as we poll our clients and we look at other Wall Street research in terms of the financial sector especially, we think earnings in the U.S. financial sector are massively understated, with a big catch-up trade coming on the earnings front, with the broader theme of scale asset managers and broker-dealers, scale meaning the big banks, but also their very small banks we think can do very, very well. And just polling our clients that we speak with, we continue to believe that the majority of clients on the institutional side are at best neutral, meaning market weight financials, and there's more to come there.
So you sort of poo-pooed the valuation argument as a reason to be cautious. So what do you think is then a reasonable valuation, and when do you start to pay attention to it?
That's a trap question, Sarah. Thanks for trying, but I'm not going to give you a number, because I think anybody that says 22 times is the number, that's simplistic math. The market is not as easy as coming up with a valuation metric and an earnings target. That doesn't equate to how you model markets. We model markets from a macro PE compression, longer-term PE trends, and a dividend discount model. When you take a look at a dividend discount model, we can squarely get to 6,700, especially where rates are going to go. With respect to where you look for value overall, we can talk about that. We've been bullish in print in the published marketplace for well over a year on small cap stocks. Other people talk about small cap stocks, and we've been in print on it. Why? If you take a look at all of valuation metrics, not just PE, if you look at PE, price to sales, price to book, price to free cash flow, operating metrics like return on assets and return on equity, Sarah, these small cap companies look amazing, and we're starting to see more and more broadening out with respect to performance there. From a fundamental perspective, we really think small cap stocks and mid cap stocks are going to do amazing over the next 3 to 5 years.
Cathie Wood emphasizes the market's potential as interest rates drop, predicting broader participation and highlighting innovation, especially in AI, as a key growth driver. She remains bullish on U.S. equities, particularly small and mid-cap stocks, focusing on long-term strategies and consistent economic growth rather than market timing. Drawing from historical parallels, Wood sees policies like tax cuts and innovation-focused measures fueling investment and economic expansion. She expects the U.S. to remain a global leader in transformative innovation, driven by technological advancements and a resilient market. How do you see AI advancements reshaping industries in the near future? Do you share Cathie Wood's optimism about U.S. markets and innovation? Why or why not?